All right, we're back. Thank you very much. We wanted to ask Mike and Matt to expand on some of the themes that would be helpful to your companies in dealing with this transitioning insurance market. So guys, take it away.
A couple of additional items with regards particularly to your loss runs. And again, our staff can help you out with this, but us as producers need to, we're going to have to be more aggressive on this. But one of the things that we talk about is under the claim section, not only giving a detailed description, but whether or not those claims are actually in subrogation. That will help on a big level perspective with underwriters and whether or not those are being subrogated or there's some subrogation payout, some form of subrogation going on. And again, if anybody's not familiar with subrogation, that's basically our carrier pays the claim, turns around, there's another carrier potentially liable for that claim, and they're in the process of trying to get that money back that they paid on your behalf or our insurance behalf. I think that's going to be more critical as we move forward. Underwriters typically used to take loss runs, look at them, put them into their models, and kind of leave it as is. But now we're getting a lot of scrutiny. Two things are happening. One, insurance carriers aren't giving the detail on the loss runs anymore. So we're having to develop that. And then two, underwriters are getting critiqued by their auditors to basically say, hey, you got to justify why you're taking this account, why we're quoting this account, because they've had this kind of trending on their claims. So I think looking at a subrogation situation, if you have that, that's critical. If we haven't handled your account for a significant period of time, we'd want to know those items. I think that covers kind of the loss run side of things. One of the other things that we talked about doing was loss control is big. I think along with loss control, if you're doing any kind of upgrades to your equipment, your auto fleets, any kind of servicing work, that helps sell the risk to the underwriter. You'd be amazed at just putting an annual tire rotation program, things like that can have an impact with the underwriter there. So those are the things to think about. And again, a lot of it's incumbent upon us, but in discussions in your pre-renewal, what you've done maintenance-wise, if you've upgraded equipment, typically we know about that because we add it to the schedule, but we want to talk about that and put that into our illustration as we present that to the underwriters.
And just one more comment too, I think what Mike said about subrogation is really important, and just consider too what subrogation really is. Subrogation, like Mike said, it's a way for that underwriter to be able to say that our insurance somehow able to recoup losses for this claim that's been paid. And you can either do that through legal subrogation or you can do it through contractual subrogation. And that's just another point that really emphasizes the need to make sure that the risk transfer provisions in your contracts, whether again they're going upstream or downstream, are appropriate and that they maximize your interest to the extent possible. So again, like Mike said, that's something that we're here to help you with, to make sure that your contracts have the right amount of risk transfer, appropriate, fair risk transfer, and that potentially give that underwriter the opportunity to know that there's some pool out there's some possible recovery that he has to be able to justify giving you the price that he does. So I think that's important. Like Mike said, one more thing too, on just really trying to help sell yourself to the underwriter. Let us help you sell yourself to that underwriter in the best possible light. Like Mike said, tire rotations, take pictures of what you're doing. Let us include those pictures in your submission. Let us do whatever we can to help sell you to that underwriter to get that best premium possible.
One other item that I've found critical in a couple of accounts and marking them, and Matt's worked with me on this, is we've looked at POs or change orders, and Matt's developed some language on that, on the back of them, that trends towards your subcontractor agreement, or if you're not in a subcontractor situation or a GC situation, both ways, or you're working direct with a homeowner, direct with a commercial owner, the PO or the change order has some indemnification provisions on the back of it, which can hold up. We've used those with underwriters to, you know, to basically build up the risk from a positive standpoint. That's something you can.
Absolutely. Jeff and John mentioned that earlier. It's important now not to just have risk transfer clauses in your subcontracts, but you need that in your supplier contract arrangements. You know, supplier indemnity is so important, and not just try to rely on a PO and maybe common law protection. You need to have some sort of express risk transfer in your agreements with your suppliers. So I know that's an extra hoop, and it's kind of a pain, but it's important. And then one more comment too for subcontractors, it's also important, I think, to try to make that general contractor or that upstream party aware, same applies to a general to an owner, in your proposal documents of where you stand from a risk management perspective. You want to make sure, if possible, that upstream party knows that you want to have an agreement, you want to make a business transaction here, but you want to have fair and reasonable risk transfer protections in your contract. And the way to alert that, General, is in that proposal document. So we can help you come up with some language to include in your proposal documents that tells that upstream party, this is what we would expect and what we would like to negotiate to make sure that that protection is there in the ultimate contract that's signed.
Great, thank you. Next slide, please. Let's transition to a little different topic, and this is a kind of a hit parade of big construction issues we're seeing right now and some of the strategies for dealing with them. Apartment construction, as you all know, is very, very hot all over the country for all kinds of good economic reasons. Apartments present a lower risk profile than for sale residential, no question. You don't have the situation where you're selling units to a consumer. You don't have a homeowners association. You have tenants who you can manage from a legal perspective a lot more effectively than you can manage buyers. But apartments still have some risk management challenges to them. We're thinking here about the downstream liability that you, as the apartment developer, general contractor, or trade contractor, might have to a later buyer of the apartment asset. So your exposure doesn't stop once construction is complete and once the apartment project is up and running and stabilized. If the apartment owner decides to sell to another apartment owner, that buyer has got some potential claims for construction issues back against the original construction and design team. So you want to be thinking ahead to that potential exposure, and particularly the exposure that could be created if buyer number 1, 2, or 3 decides to convert the apartment asset to condominiums. And that's, again, going to be a function of the real estate market. In some markets, we're seeing a lot of conversion activity now. Other markets are going to follow. So a couple of thoughts about that. The construction defect exposure that a condominium conversion presents is just the same as new construction. And in fact, John, I think in some ways, it's worse. How could it be worse? Because the original construction parties may have thought they were building an apartment asset. They may have designed and constructed to apartment specs. That doesn't stop a future buyer from converting. And as a result, you've got all the usual construction defect and other litigation exposures presented by a conversion, and you may not be insured for it under your current conventional annual renewal program. In fact, many of you may have residential or condominium exclusions in your policies, very typical. How do you hedge those risks? If you're the owner of the apartment asset and you sell to a converter, you've got a menu of possible risk management strategies you can pursue. You can try to record something on title so that future buyers of the apartment project can't convert. Doesn't work in most states, but it's tried pretty widely. You can also have some contractual protections. If you're the original apartment developer, you sell to somebody, you can say, if you or any future buyer converts the apartments to condos, then you will provide indemnity, appropriate condo insurance, and other risk transfer provisions. That's a good strategy, but it's got two problems. One problem is the other party who makes all these promises may simply breach or not be around at the time of the conversion. The other problem is those promises by buyer number one to indemnify and insure, they don't bind buyers 2, 3, and 4 unless buyer number one puts them in his or her contract. It's a lot to manage. So what are apartment owners doing about the future conversion risk? Some of them are buying condo coverage up front, but that's a very small minority. It's very pricey. It's not practical from an economic perspective, and frankly, you may never need it if there is no future conversion. You can also buy a general liability wrap-up that gives you a condominium conversion option. So if in the next 2 to 3 years, you or a buyer convert the asset to condominiums, the condominium conversion option gives you the ability to pay some additional premium at a predetermined rate and have coverage for the condo exposure. That's a pretty good option, but it's also relatively pricey. And the option only can be exercised for a short period, maybe 2 to 3 years. And that market is very thin. Only a few insurers are willing to do that. So the last option is basically close your eyes and hope. And a lot of apartment developers are doing that, contrary to what they're being told by their professionals. That's not a great planning strategy, but it is one that some owners are using. Commercial projects. You don't really think about CD claims on commercial projects much, but we are seeing more activity by plaintiff lawyers and plaintiff experts on commercial projects. How can that be? You don't have consumer buyers. You don't have a condominium association. How do those come up? It turns out that a lot of commercial projects are having construction defect activity, but it's on the part of the owner of the project, the single tenant user, or a future buyer. The thing that's difficult about commercial CD litigation is it's kind of hard to predict the magnitude of it up front. Commercial projects, by their nature, have generally got larger construction values, more complicated assemblies and systems, and are built to generally higher commercial grade construction than type 5 stick framed wood stucco construction. I mention this because it's a looming threat to the commercial owners and contractors and trades, because in some markets, because there were so few residential units constructed during the downturn, there's been a period of time coming up rapidly where there's not enough inventory of homes for the plaintiffs to sue on. I know this sounds really cynical and almost twisted, but it's an economic fact. The plaintiffs need to feed the pipeline, so they're going to be looking at commercial projects. And same risk management tactics apply there as they do on residential. Now I want to talk for just a minute about design professionals. And if you are a design professional, or if you engage them, or if you do any design build work and have design professionals as part of your team, these issues are pretty relevant. John and I confront this a lot when we're negotiating agreements with architects and engineers. The architect and engineer always makes the same argument. She will say, I'm only getting a fee, I have no upside in this deal, and my liability is very large. I need to be protected. And as architects and engineers get busier, you will hear that theme more and more, and they will become more assertive in pushing that theme. So what do you do about this? We want to start from a good, solid design professional contract, prepared by the owner or the GC, whoever is the recipient of the services. Don't be signing any professional's proposal. Don't sign their form. I know it's easier, I know it's faster, but it could be fatal. Why? Because at the back of a proposal is a page or two of pre-printed conditions in really small type. And in those pre-printed conditions, you'll find the following. A limitation of liability clause that limits the professional's liability to the amount of fees or some other small number, regardless of how the claim comes up. You will also find a reverse indemnity where you, the owner or the contractor, indemnify the professional. Yikes. I don't know if I've got the ability to do that, the owner or contractor says. The other problem is the owner or the contractor does not have any coverage under its own CGL policy where it indemnifies an architect or an engineer. It doesn't qualify as a so-called insured contract. The other thing you'll find in the pre-printed fine print is a limitations period on claims that's a lot shorter than what the law provides. The professionals like to put in a provision that says any claim arising out of the services must be asserted within X months or X years of completion of the services, regardless of what the legal limitations period is. It gets worse, but I think you're getting the flavor of this exercise. Don't sign the proposal. So when you present your form of contract, all of these adverse risk transfer provisions are going to come back in the form of changes to your contract. So what you want to try to do is hold the line as best you can. Try not to let the professional dilute the indemnity provision too much. A very typical response from the design professional will be, all right, I will drop the reverse indemnity and I will indemnify you, but only to the extent of my negligence. Is that something livable for the owner or the contractor? Depending on the leverage and the negotiating positions in the deal, yeah, it may be. Why is the professional saying that? They're taking that position because they want the indemnity to be as narrow as possible to track their professional liability insurance coverage, which covers actual or alleged negligence. That may be a decent compromise depending on who's got the leverage. We prefer the indemnity to be broader, and a practical tip, sometimes we create a two-part indemnity. One part deals with indemnity for liability arising out of the services, professional negligence. Maybe you limit that to negligence. But any other claims not arising out of professional negligence are a full-blown, broad-form indemnity. Example, let's say the architect or the engineer has somebody on site and they're there for a purpose other than performing a service. They're there for contract administration purposes. They're there for a site visit. It's not really a service, it's just a construction operation. Well, if somebody gets hurt as a result of that visit to the site, you want to be able to say, I get full-blown indemnity for that claim because it's not something arising out of your services. That's a pretty decent way to improve your indemnity position with the professional. You also see the professionals sometimes want to modify or water down the standard of care. Every professional service agreement has something that says the following. Professional will exercise that degree of skill and care as is customarily used by professionals performing similar services on similar projects in this jurisdiction. Something like that. That's basically the legal standard of care. Sometimes you will see the professional modify that by saying, we will endeavor to use that standard of care, or we will use reasonable efforts to use that standard of care. That's not something you want to agree to. That's lower than what the law requires. Same thing with the provision that requires the professional to comply with all laws. This is kind of a sleeper provision. You don't think about it much. It's in the boilerplate. It's actually really important. You want to be sure the professional complies with all the laws and codes applicable to the work. Don't let them water it down by saying, we will endeavor to comply. That's not much of a standard. So two other quick points about the professionals. They will all bring professional liability, E&O coverage to the project, but please remember that professional liability coverage has some inherent limitations. Unlike your CGL policy, which is written on an occurrence basis, the professional policy is written on a claims-made basis. So when there's a claim arising out of the services, only one policy will apply. The claim in place when the claim is made the policy in place when the claim is made and reported. Well, that claim may not be made until years after completion of the services. That means the professional needs to maintain its professional coverage after completion. How long? Well, ideally, as long as the statute will propose. Will you be able to get that for your professional? Unlikely. They will propose maybe 1 year after completion. Somewhere in there, there's a compromise. But you need to realize that there may be a potential coverage gap if you don't have that professional policy in place after completion. One last thing. If the project is big enough, you can hedge some of the risk presented by the professional's E&O policy in terms of limits, duration, quality of coverage, by buying the so-called Owner's Protective Professional Indemnity, OPPI, Owner's Protective Professional Indemnity. This is an interesting insurance product that's designed to protect only the owner. You can also buy a variation of it designed to protect only the contractor. And in plain English, what it does is it sits excess of the design professional's E&O policies, the practice policies. It provides additional limits if the design professional's own policies are exhausted, not in place, canceled, whatever. You need a fairly substantially sized project to justify the OPPI expense, but on the right project, it's a terrific option for the owner or the contractor. A couple of other, let's go on to next. What do you do to hedge some of these risks? Well, in addition to what we've already talked about, you can tell, I think, that all of us are big proponents of wrap-up insurance, either owner-controlled or contractor-controlled. To me, it solves a lot of the coverage problems that we all confront in our industry. From the owner's perspective or the contractor's perspective, what the wrap-up does is it provides one insurance vehicle to cover all the construction parties. That's in contrast to the conventional insurance model where everybody brings their own liability insurance to the project. Well, you know what kind of contract administration hassles that creates. For the owner or the contractor, you've got to go out to your trades every year and get a renewal certificate, renewal, additional insured endorsements, and you're banking on them keeping that coverage in place for the long haul, because these construction defect claims often don't arise for 5, 6, 7 years after completion. The wrap-up solves that problem by putting in place one coverage for the construction participants with extended completed operations coverage. You don't have to go chasing certs and AI endorsements after completion. The negative of the wrap-up, really twofold. One is you're all relying on the same insurance policy or policies. You got one set of limits for that project or group of projects. Solvency of the insurer is a very important consideration. You want to be sure the wrap-up insurer will be there for the long haul. You've also got issues relating to implementing the wrap-up. We'll talk in a few minutes about the contract strategies for doing that. But you have to know going into a wrap-up, it's got its own administrative burdens that are probably less than the typical construction model, but there they are. So we need to be prepared for them, and LP can help walk you through those administrative tasks. On contractual risk transfer, some of the things that John and I are proposing right at the moment are try to hold the line as best you can on your indemnity provisions, subject to market conditions. As people get busier and they have more opportunities for work, it may be more difficult for owners and contractors to get broad form indemnity from the other parties to the construction process. Just a fact of business life. Be aware of the anti-indemnity trend among states. As John said, Nevada currently doesn't have anti-indemnity statutes, but there's some case law that's leading in that direction. And as Mike and John mentioned, there's legislation pending right now in the legislature that could reduce the indemnity protection that you get from your trade contractors. In your contracts with other construction participants, think about the warranty provisions. This is another boilerplate item that sometimes doesn't get the attention it deserves. The owner wants from the contractor a solid warranty provision that says, I, the contractor, will come back for X years after completion, and I will correct any deficient work, with deficient work being a defined term. It's a negotiation how long that warranty period lasts. The contractor clearly wants a shorter period, the owner wants a longer one. And the contractor will want to flow through that warranty obligation to the trade contractors. Similar negotiation will happen there. The value to John and me of a good warranty provision is it's kind of a self-executing remedies concept. If you've got a good warranty from your general contractor, you, the owner, can point to that provision and say, we need you out here in 24 hours. This is an emergency. The contractor should comply and mobilize the trades to back up the contractor's performance. It's a lot more strategic and a lot more surgical than going and litigating with the contractor or the trades on that issue, trying to get an indemnity claim, process that quickly. And last, we talk about Chinese drywall, Chinese pipes. Nobody knows, frankly, where the next major materials failure is going to come from. I guarantee there are experts for plaintiff lawyers who are thinking about it right now. So we should be thinking about it too. One thing we are proponents of is a contract provision requiring domestic content from your suppliers so you don't get Chinese drywall, Chinese pipe. Domestic content has a cost. You're potentially ruling out lower cost suppliers and providers. You want to weigh that cost against the risk of another Chinese drywall issue. And then last, this integration theme. Try to integrate the construction documents with the insurance the parties are bringing to the project. This seems really self-evident, but it gets missed a lot, and it can really benefit you. By integration, we mean if you've got a deductible or self-insured retention on your insurance policy, you're a trade contractor, the owner of the contractor may want to specify in the contract that you would be responsible for that deductible or self-insured retention. Doesn't matter what the cause of the loss is. Why would you need that? From the owner or the contractor's perspective, they want to avoid a situation where the subcontractor pays its deductible and then comes back to the owner or contractor to say, but you caused that loss, you owe me my deductible. Why not deal with the issue up front and the contractor or the sub can price it appropriately? That's an example of integration. It becomes really important in wrap-ups, as we'll see in just a moment. Well, let's go on to some specifics about wrap-ups and how to build a better one. John and I have been through so many wrap-ups, from design of the policy, negotiation of the policy, to implementing it in the construction contracts, that we've tried to refine some practical ideas about how to make the wrap-up perform better for the participants. The first thing that the participant probably sees is the wrap-up insurance manual. This is generally prepared by a third-party wrap-up manual consultant. And I'll just tell you that the idea of the wrap-up manual is really straightforward. The objective is to be able, in plain English, to explain to the construction participants what the wrap-up is, what it does, and what it doesn't do. And also how to report claims and incidents. So it's a working guide to the wrap-up. Unfortunately, we see wrap-up insurance manuals out there in the marketplace that go way beyond that. You see text that will say things like, a wrap-up is designed to provide high limits and broad coverage for all construction participants to address the liabilities presented by the project. Wow. How many different representations were just made in that one sentence? You wouldn't want to say anything like that if you're the sponsor of a wrap-up. We're big believers in the Sergeant Joe Friday School of Drafting. Remember Joe Friday from Dragnet? He used to say, just the facts, ma'am. That's what the manual ought to do, just the facts. Here's the wrap-up, here's what it does, here are the coverages provided and the limits, here's how you report claims, and by the way, this manual does not provide coverage interpretations. The manual is a user's guide. The other thing you worry about with a wrap-up insurance manual is it going to be incorporated into the contract documents or is it not? If you incorporate it into the contract documents, then you're risking inconsistency between the manual and the wrap-up insurance exhibit to the contract. So you want to be aware of that and make a decision, do you incorporate it or not? Oftentimes we don't. Next slide, please. John has a number of thoughts about wrap-up insurance exhibits. These are different from the manual. This is an actual exhibit to the construction contract. And John, what's best to include and what could go wrong?
So we are talking about another key step in implementing the RAP, and here we're talking about language that now is an express agreement between the developer or the GC and the other participating parties. This is the step of incorporating a wrap-up exhibit in both the owner-contractor agreement and in the subcontracts. The point being to clearly describe as best we can the program, its features, the obligations of each of the parties, the benefits of each of the parties. It also is an opportunity for the sponsor to be clear about what they are not disclaiming liability, what they are not promising to control their own risk in part. In California, the content that would go into a RAP exhibit is somewhat controlled by statute, at least supplemented by statute. The indemnity statute we talked about earlier also includes a section that says that the contract documents have to include certain disclosures to be in compliance with law. That includes details of the program, limits of the program, any projects that RAP may apply to, limits still remaining on the wrap-up project policy if it's a policy that applies to more than one project. There are slight differences in the law depending on the type of project, residential versus commercial, but the underlying point is the same, which is an obligation for that which the legislature deemed to be kind of the crucial core information to be conveyed to the participants. Our view of the best practices goes, in terms of what these should include, goes well beyond that. This is the opportunity for the parties to be explicit in what is being provided and what is not being provided, what the obligations of each party are going to be in the context of a claim under the RAP, and as important, how the program's self-insured retention or deductible will be shared. The exhibit, of course, will also set out provisions related to cost, how insurance credits will be handled and calculated. And also, kind of turning to what's not provided, a good exhibit will set forth the coverage which is not being provided. Often, no property coverage provided, no workers' comp, no auto, and in conjunction with that, the exhibit will usually set forth those other lines of insurance that are still required by the participants. Ideally, this exhibit will continue the integration of the insurance program into the project documents and benefit, hopefully, of controlling expectations on both sides, as well as to create an advanced, clear program for all the RAP participants.
Let's spend just a few minutes on a little bit of inside baseball on wrap-up insurance coverage. And this, we hope, is going to be of practical help, not just to the sponsors of the wrap-up, the owner or the contractor, but also to the trade contractors who are going to be enrolled in the wrap-up. These are some of the things that you might look at in terms of wrap-up coverage and how it addresses your particular risks on the project. We use the term negotiating the wrap-up policies, and you know from working with LP Insurance Services that off-the-shelf insurance policies don't always meet your needs. there needs to be some tailoring, some customizing to your particular situation. A wrap-up policy is no different, and in fact, it probably requires more customization because you're dealing with a broader range of insured parties, owner, contractor, trade contractors, each with different needs. So here are some of the things that keep John and me up at night lately. One of them is the wrap-up covers the project, okay? How is the project defined? Is it even a defined term? Sometimes you'll see a wrap-up policy that just says, description of covered project, and there's a street address. Well, I don't know, is that good enough? Probably not. I mean, we really ought to be thinking about what the project defined term really entails. For example, let's say you've got a laydown or a staging area nearby, and you want any bodily injury or property damage arising out of that area to be covered under the wrap-up. You would need to specify that. You would need to expand the definition of project to include adjacent or nearby areas incidental to the work, or some words like that. But it requires some thought about where the risk and the exposure might come from. We had a situation not long ago on a commercial project where it was a very tight urban infill site, and they were using a tower crane. The crane swing encompassed almost a half a block circumference around our site. How was the project, quote unquote, defined in the wrap-up policy? Well, some careful thought had to go into that. That crane swing created exposure to adjoining property owners, pedestrians, traffic, and a publicly owned transit station. We had to define the project broadly to cover all that stuff and help the underwriter understand why that was appropriate and why it could be priced. Another big issue under wrap-ups, and one of our guests asked a great question on the break. If I, as a trade contractor, enroll in a wrap-up, and I give a 20-year warranty on my work, my component, which effectively is a turnkey module, is the wrap-up going to cover me for that 20-year warranty exposure? Probably not. Most wrap-up underwriters will not write extended completed operations coverage for longer than 10 years. Some will. Some will give us what we call statute coverage, not limited to 10 years, but in effect as long as the statute of repose is in place. That's a big issue, because if you get a shorter completed operations coverage period under the wrap-up, there could be a mismatch between your coverage and your legal liability. Big issue for all the participants. Another issue is what we call repair work endorsements. This is a nice coverage enhancement that's now become pretty typical. Let's say you're a trade contractor, you're enrolled in a wrap-up. After completion of the work, you are called back to do some repairs of the project, residential or commercial. Is the wrap-up going to cover you if you hurt somebody during those repairs or cause some property damage during those post-completion repairs? Under the repair work endorsement, the answer needs to be yes. Question is, how long is that coverage extension? Ideally, you want it to be as long as the extended completed ops coverage extension. Some underwriters limit it to 2 years, 3 years, 4 years. Something to watch out for, no matter what your role in the project is. The other issue from the owner's perspective is, that's great, I've got repair work coverage, but what if one of my original trades is out of business or no longer available? Can I get wrap-up coverage for a substitute to come in and do the repair work? Sometimes we are successful in getting the policy amended to provide coverage for a substitute contractor so long as they're licensed and reported within X days. Next slide. A couple of other negotiating tips, and we're going to go pretty broad brush on this. Most wrap-ups today have an exclusion for property damage to the project while it's under construction. Property damage to the project during ongoing operations. This is a reduction in coverage compared with a standard liability policy, so it's a significant issue. And as we'll see in a minute, we need to do our best to plug that gap by having a great builder's risk policy for the project. Exclusion J2. This is most of concern for sale residential, but I want to raise it so you've at least got it in your mind, looking ahead to future projects. If you're the owner and you're a named insured, you have no coverage for property damage to premises you sell. No coverage for property damage to premises you sell under this exclusion. Well, wait a minute. Doesn't that mean I have no construction defect coverage? It would mean that, but there's an exception to the exclusion. There's an exception where the premises are your work. In other words, you or your trades built it, and the premises were never occupied or rented, or held for rental by you. In plain English, what does that mean? It means you've got construction defect, property damage coverage for premises you sell. If the premises are your work, you built it or your trades did, but you can never have rented it or held it for rental. Think about that. We've just been through a 5-year residential downturn. How many condominium projects and single-family homes do we all know of that were built for sale but rented during the downturn because there were no buyers? Exclusion J2 is a big trap if it's not modified appropriately. It's also a big trap for condo conversions because the converter may buy the asset, rent the units for a while, then start their sales program. Prior work coverage, we've talked about some. Anytime you're getting involved in a deal where there's work that was completed prior to your involvement, you have a prior work issue, and the policy would need to be tailored to manage that exposure. And last, we talked a little bit about buying apartment assets and converting them. This next bullet really deals with that situation. Here's the scenario. You're an investor. You're buying an existing apartment asset. You're in the due diligence period. You'll learn a lot about that project. You know the works. You know something about how it was constructed. You've read the maintenance records, the repair records. You know a lot about that project. Now flash forward. You're placing the insurance to protect you from liability arising out of that project. The insurance policy's probably got an exclusion for damage that you know about, prior damage, prior injury, prior defects. Well, think about what that means. You may have walked yourself into those exclusions because you know a lot about the project from your due diligence. That's got to be managed. The policy has to be manuscripted to clarify that despite what you know, you've still got coverage. And of course, LP will tell you the submission for that project needs to include a lot of information about your diligence efforts. The last thing you want to do is mislead the underwriter in some way. Interesting issues, and this stuff comes up all day. Quick point about builder's risk. I mentioned a minute ago that the wrap-up is going to exclude coverage for property damage to the project during ongoing operations. We try to modify that. Admittedly, we're not always successful. So the fallback would be, all right, let's get a great builder's risk policy in place to give us that coverage. It's tough to manuscript a builder's risk policy to be broad enough to fully close that gap. We try to get as close as we can. The reason for that is most builders' risk policies have an exclusion for faulty workmanship, faulty design, etc. So there's a bit of a mismatch between the coverage the owner-developer needs and what it can reasonably get under the builder's risk. One of the things that we've done over the years is try to help the clients work with their brokers to get a broad builder's risk policy form that at least gives you coverage for the cost of repairing resulting damage. Here's the scenario. During construction, a workmanship issue arises. You get a lot of water intrusion into the project under construction, and you are able to identify the source of the water intrusion. The cost to repair the source of the intrusion is $100. The cost to repair the resulting property damage, $1,000. typical scenario. We'd like to get the builder's risk policy at least to say, we'll cover the $1,000 in resulting damage. We won't cover the $100 to repair the actual condition itself. And then subrogation claims. Matt and Mike mentioned subrogation before. If your wrap-up policy has a large deductible or large self-insured retention, this is a significant issue. The good news is most wrap-ups today, we're dealing with much smaller deductibles than we were 2-3 years ago. But it could be an issue as the market tends to firm. Let's say the builder's risk insurer pays that loss we just talked about. They pay the $1,000. They want to subrogate against somebody to recover their $1,000. They subrogate against one of the contractors enrolled in the wrap-up. That contractor turns around, takes that builder's risk subrogation claim, tenders it to the wrap-up insurer and says, here, you deal with this. Well, who's going to pay the deductible or the self-insured retention on that claim the contractor just submitted to the OSIP, the wrap-up insurer? As John said, unless you deal with that issue in the wrap-up exhibit, that's going to fall on the owner if the owner is the sponsor. Well, if it's a large deductible, that may be an unwelcome surprise that the owner hasn't reserved for. What do you do about that? Try to cut off those builder's risk subrogation claims, name the contractor and the trades as insureds under the builder's risk policy. That's one way to cut off subrogation. They can't generally subrogate against their own insureds. Second strategy, backstop. Have a good waiver of subrogation provision in the construction contracts. So there's a contractual waiver and a waiver in the policy. And last, you still have a little bit of flexibility in this in the wrap-up exhibit. Just say what you mean, which is, in the event of a builder's risk subrogation claim, the enrolled party, who's the subject of that claim, agrees not to tender it to the wrap-up. Or, if they do tender it, there's some sharing of the deductible responsibility. Just think through the scenarios and draft up something that's reasonable, that makes sense for the parties. Interesting. A lot of practical issues. Two other quick issues on wrap-ups, and then we're going to move on to another topic. This is another one that worries John and me. What if you've got somebody doing off-site fabrication and installation on the site? So they've got an off-site exposure and an on-premises exposure. It's really hard to get a clear answer from underwriters sometimes on whether or not that off-premises exposure is covered. And we worry about this because you could certainly have that fabrication off-site leading to bodily injury or property damage, either off-site or on the site of the project. Where's the coverage for that? I'm not saying it has to be under the wrap-up. It could be under the conventional CGL for that trade that covers their off-site operations. But wherever the coverage is, let's try to understand where it is and specify that in the contract documents to avoid a potential gap. The other worry is the trade contractor probably has an exclusion in its conventional CGL policy for any claims covered by a wrap-up. So if the coverage isn't under the wrap-up, you may not have it under the contractor's CGL policy. It's a question the sponsor needs to be asking up front. Where's the coverage? Who's going to be responsible? Do I need to make contractual arrangements for that? And then last, this is a great issue that Matt and Mike had raised. Don't forget that under your conventional policy, but especially under the wrap-up, the insurer may be able to come back and audit that project and charge additional premium later. Typical example, the owner says, we're going to buy this wrap-up. I'm estimating sales revenue for a for-sale project of X million. The insurer says, that's fine, I accept your estimate, and any overage will be charged at the rate of X dollars per thousand of sales revenue. Everybody forgets about that. The project sells out, it's a huge success. Sales revenue is 1.5x what the estimate was. Home run for the developer, right? No. There will be an audit. the .5 increment's going to be discovered, additional premium will be charged, and it may not happen until 3, 4, 5 years after the project is complete. Matt, Mike, is the owner reserved for that exposure? We hope so. An unwelcome surprise. And that's one of the things that LP can do, is to keep you informed about the nature of the additional premium. We've tried to get something like a margin clause where if the revenue is only 10 or 15% more than the estimate, there's no additional premium. Thank you very much. So another planning issue, the additional premium. Mike, Matt, any thoughts about that?
Again, I think that's one of the, and I maybe defer to Nick and John on this, but most don't anticipate that additional premium. I mean, at the end of the day, I don't think they do. But I think that's up front. If you can get that up front and you can discuss it, look at it, and calculate it. Again, we mentioned this, I don't know how, from a tax standpoint, that works for you as an owner or a contractor. But I think knowing about it, that it could be a potential issue down the road, that's probably the key item there.
Yeah, I think that's right. We had the unhappy experience of a couple of owners who had wrap-ups on substantial projects, did a deed in lieu of foreclosure, gave the project back to the lender, hadn't thought about the additional premium exposure. After the deed in lieu was recorded and they no longer were entitled to these projects they had developed, they get an audit premium billing from the wrap-up insurer. Oh, wait a minute, your sales revenue was a lot higher than you estimated. That's a terrible spot to be in. That's sort of the worst case. A couple other quick points on wrap-ups. It's possible to enroll your design professionals, architects, engineers, in the wrap-up and get them coverage for bodily injury and property damage, even though that injury or damage arises out of professional services. This is a nice coverage enhancement, and it tends to help you mitigate the risk presented by the professional's E&O policies. We talked about that a few minutes ago. The professional's E&O policies may not be in place when the CD claim occurs. If you've got this coverage enhancement under the wrap-up, at least you know the professionals have coverage for property damage as defined. And then an emerging issue, this gets into the interesting thicket of which insurance has priority. Under the wrap-up, the sponsor, the owner or the contractor, wants the wrap-up to be primary insurance and deal with any claims or suits arising out of the project. We're seeing some activity in other states, not Nevada yet, where the wrap-up insurer comes back and says, yeah, I know I said I was primary, but I think that I'm excess of any other insurance. Other insurance? We have a wrap-up. The insurer may say, yes, I mean other insurance carried by the trade contractors and the contractor for their other exposures, their practice policies. In other words, we want the conventional annual renewal policy of the GC and the trades to pay first, then the wrap-up insurer will pay. It raises a ton of issues. Do those policies have wrap-up exclusions so the whole issue is moot? Does the law of the state require horizontal exhaustion in that way? Interesting issues. The other place that comes, yeah, Nick?
Jeff, just to really interject, you mentioned you haven't seen it in Nevada, but recently, within the last week or two, there's a very, very aggressive form marketing for contractors here locally that has that exact clause. My question to you, though, could you expand a little bit? If a client finds themselves in that type of an OSIP, how does that affect your ability, if you were defending that OSIP insured under the duty to defend clause? If you've got a claim that's barreling in at the OSIP owner, and all of a sudden the insurance carrier is saying, we've got to go out here and investigate 55 policies for valid and collectible insurance first. Is that your concern, or is it in some other arena?
Next comment and question was, what if you're in that scenario and the wrap-up insurer says, I'm going to hold on making a decision whether I defend you until I investigate all this other valid and collectible insurance? Yeah, that is the concern. Delay in the wrap-up insurer assuming the defense, costs to the insureds, our clients, to try to deal with these coverage issues, which ought to be clear up front. And third, a possible issue about allocation of the ultimate settlement monies. In other words, is the wrap-up insurer going to try to take hostages when it comes time to pay settlement money and say, we're excess of that other insurance until they exhaust, we're not going to participate. Pretty aggressive position. That could happen. And one of our favorite strategies is at least get the wrap-up insurer in defending early, because once they're defending, you've got a much better position to argue for indemnity or settlement money than if they're refusing to defend. Is that responsive to your point?
Yes, very good.
Thanks, Nick. Questions about any of that? And I acknowledge that was a lot of info in a short period of time, and it was just to give you a flavor of some of the wrap-up issues that we're wrestling with and that we'd like you to be aware of. Well, let me then ask, actually I'll take this next one. Some residential project strategies. We use the phrase harden the target. We like this comprehensive, integrated risk management model. And if you're doing new residential construction, whether it's detached or condominiums, townhomes, this is a bit of a menu of things that we really advocate for the developers and owners. Design and construction quality assurance. A lot of people talk about QA programs. They're not implemented as effectively as I think they could be. And what we're talking about here is two things. On the design side, if you're doing a condominium project of any size, we think it's prudent for the owner-developer to engage a third-party architectural consultant who's got forensic litigation experience to review the drawings by the architect and other professionals of record. What they're looking for is errors or flaws or difficult issues in the plans and specs that may lead to a claim later. The forensic architect, based on experience, is probably going to see things, assemblies that are too difficult for trade contractors to build because they're new or unfamiliar. The need for building mock-ups of particular assemblies and details so that the trades can do the job they want to do. Lack of code compliance. Those are the things that are going to come out of that peer review of the plans. It's not expensive, it is really worth it. The other thing is construction quality assurance. And this is going to be required by virtually any wrap-up insurer for a residential project. This is shorthand for having a third-party consultant come out, do on-site inspections in real time, document construction conditions, and most important, document that the construction is correct in its as-built condition. It's that last step that's really the most important. If you just have somebody reviewing construction in real time and they don't prove it was correctly completed, you're worse off. You've got a roadmap for the plaintiff lawyer to follow. If you can document correct as-built conditions, that's where you want to be. Pre-qualifying trade contractors. This is something our production builder clients are really focused on right now. Because of the downturn, because there's been so much turnover in our industry, they want to be sure that the trade contractors they're working with meet the essential requirements. Loss control, safety, OSHA compliance, ability to provide insurance, all the blocking and tackling that you would imagine. The builders are really focused on now. So the trade contractors who can get through that pre-qual process are going to be very well positioned to do more work for the production builders. Contract administration, I know LP helps a number of you with this. This is shorthand for being sure that the contract that gets signed is as close to your form as possible. And if you're diluting or watering down the risk transfer provisions, be sure you do that knowing what the impact may be. And tracking certificates, tracking additional insured endorsements. Again, all the fundamentals, still very important. Just one other quick thought, compare and contrast Nevada, California. California has this odd rule that you can use a third-party QA consultant all you want, but the reports by the third-party QA consultant, a so-called qualified person who's an ICBO certified inspector, those reports are not admissible in court in a CD lawsuit in California. Now wrap your mind around that. Not admissible in a construction defect lawsuit in California. In a minute, I'll share with you the backstory on how that happened, but from a practical perspective, in California or Nevada, you're generally not going to be in trial on a CD case. The vast majority get resolved in mediations, as John says. The law in California doesn't say you can't use it in a mediation. You can do that all day long, so it's still got persuasive value. How'd that happen? It reminds me of the story about Will Rogers, who once said, as an American, the only time I really feel fear is when the legislature is in session. In connection with our right to repair law in California, a little-known part of the legislative process was to give immunity to third-party QA inspectors. The legislature did that. The quid pro quo was they get immunity, but you can't use their reports in a trial of a CD case in California. So it leads to some practical issues, but our view is it's still very worthwhile doing, and it's going to be required by the wrap-up insurer. A couple other quick points, and then we're going to finish a little bit early and have plenty of time for questions. Homeowner and HOA maintenance obligations. This has always been an argument that we've made defending builders in CD cases, that the homeowner or the HOA just didn't maintain the project properly, and as a result, that's the cause of the damage. Never had much traction historically. You try. Our right to repair law in California finally made the lack of maintenance defense a recognized legal defense, and it's actually had some ability to affect the outcome of the claims. I say that because builders are doing a much better job of putting maintenance obligations in their consumer sales documents, their declarations, and also giving maintenance manuals to the homeowners and the HOAs. That's something that is actually paying off for us, and we strongly recommend it. And last, disclose. As John said, the construction defect claim often gets linked up with a fraud claim. The builder didn't tell me this about the home. They didn't tell me this about the community. They didn't disclose the HOA assessments properly. All of this is fertile grounds for add-on claims in the construction defect lawsuit. So our rule is disclose. Use disclaimers where you can. For example, in most states, you can disclaim an implied warranty to the homeowner as long as you give some kind of an express warranty, which most builders do. So don't leave any of it on the table. Use all those tactics.
Jeff's talked about some key strategies for new projects, and so real quickly, a couple of key strategies on past projects. We recommend a smart defense with protocols and strategies that are discussed internally well ahead of time. Attention to past projects is important for a number of reasons, but a couple to point out. One, obviously well down the road after homes are sold, there's still a significant role that builders can play in controlling the risk exposure for this past inventory. And two, if left unattended, there's obviously significant costs that can be incurred. We often discuss kind of a mantra of risk management, of terms we use: avoid, minimize, shift, or ensure the risks. When we we look back at past projects, we see a lot of opportunity to either avoid the claims or minimize the claims. One key one that we often espouse is long-term customer service. This isn't just a walkthrough and a check-in after a year. This is staying close to the homeowners well through the statute of limitations. Many claims originate with either a real or perceived failure of customer service, so we are often recommending that where builders and developers have the resources, that they maintain the contact with homeowners, the responsive customer service front, and this tends to be extremely useful, either in avoiding claims, educating homeowner, controlling expectation, and really getting them to call you first and not their attorney. Also helpful is having a solicitation response protocol in place ahead of time. Often the first time we hear about plaintiffs trolling neighborhoods is maybe a homeowner tells another homeowner that they've spoken with an attorney, and that homeowner lets the builder know. About the same time, just about every homeowner gets something in the mail saying, hey, we've already signed up, plaintiff attorney talking, we've already signed up a bunch of homeowners, you could be having the same horrible issue. Here's some file copy photographs of issues we're seeing. The best response is one that's ready to go, involves developers' own letters ready to go out to the homeowners. Again, if they have the resources, immediately walk in the neighborhood that weekend if they can. And often using some third parties to go door to door and remind the homeowners that the builder is still around, there's a warranty, the homeowner is obligated under the documents to talk to the builder first. Hopefully the goal being reduce the numbers that may end up in that suit. And often, and our clients have had a lot of success with this, which is convince people that have already signed up for the suit to drop out. Generally pre-claim, pre-litigation tactics, like you said, is basically to begin the defense of the claim immediately at that solicitation stage, talking with your consultants, talking with your brokers, having a strategy for how you're going to respond to the solicitation when the complaint hits. A lot of our clients will track, it's depressing, but track the filings at the courthouse so that they know the moment that a complaint is filed. It's helpful because there's a lot of plaintiff firms that will file a complaint just to kind of preserve the claim, be careful of statute of limitations, but they won't serve the developer often for months. They'll file a complaint, and they'll continue to try to build a size. I think it's because I mentioned plaintiff attorneys. Plaintiff attorneys will often spend that time between the time they file and serve to continue the efforts to build the number of parties in the case. Our clients will see that there's been a filing even before they know about it or before they've been served, and will hit the neighborhood and control the number of people that sign up. And lastly, another point, we talked about the tools that we recommend that parties have to control risk, and one of those is to work in ADR into the purchase and sale agreements with the home buyers, ADR being arbitration or other forms of dispute resolution outside the context of the courtroom. So if there is a suit in fact filed, we are big proponents of trying to keep those out of the hands of a jury and pushing for the enforcement of arbitration. So to bring full circle, these kinds of efforts, whether it be looking forward or for past inventory, hopefully you get the benefit of reducing claims, reducing severity, protecting your loss history, avoiding that SIR exposure. At the same time, taken all together, if these procedures and protocols can be presented in a efficient, convincing way, hopefully that company will be able to differentiate itself with the help of its broker and have access to the best insurance on the best terms and impress an underwriter with your risk strategy.
Questions or comments? Nick?
Jeff, just one question, and John kind of hit on it at the last slide. That long-term customer service, you know, you see a lot of your builder clients implementing something which is beyond, my gosh, what used to happen 20 years ago, where you had that one-year warranty. Are you indicating that this long-term proactive customer service, is it going out to the statute of limitations?
It's really builder to builder. You still, the builders are still electing, depending on the market, to have contractually safe, limited express warranties, which may be 2 years for certain items and longer. Side note to that, we have certain builders in certain markets where, you know, the competition for buyers front and center on the ad materials that are out there is the length of the warranties that are being offered. So some builders are facing some pressure that way to increase the length of the warranty. But, you know, with a lot of our clients, irrespective of how long they're obligated contractually, you know, they're making that decision of how long they want to be answering the phone. And, you know, a lot of them are doing it well into the statute and you know, going out and visiting a homeowner in year 7, 8, because they know those are the projects that are susceptible to suits. You know, internally, they're going to set what they think is acceptable. Sometimes it's $1. They'll tell me, look, John, if I can resolve this, you know, for $2,500, $5,000 less, I'm going to do it because I know the costs I'm going to be facing. You know, if this goes to suit and I'm facing, you know, paying the SIR. You know, sometimes they'll foot the bill themselves. Sometimes they'll turn to the trade partner and say, hey, can you come out and help me with this? And, you know, the cost to have their own parties, their own trade partners addressing this is just pennies on the dollar often. So this is usually outside of what they would be contractually required to attend.
You're seeing positive results in that
They are.
strategy?
A lot of these builders are keeping the numbers in suits. They're, they say, hardening the target, and keeping these parties out of the case, whether it's before or after. So, you know, I'm not, as it is, what happens, I don't get called as much. They use, they may incorporate a form release agreement that maybe we've given them a while ago to check in with us and say, you know, we went out, the homeowner was really upset about something, but we'll explain that part of this is maintenance. Part of this is something that shouldn't have happened, and we're going to educate you on how to do it one time only. We're going to recaulk for you, we're going to do a little paint. In exchange, sometimes there's the opportunity to get a release. So that's not always possible, but you know, the higher the dollar figures you're talking about, you know, the higher, the more a builder will see a reason to put a release in front of them. So you know, they're getting something out of it as well.
And then, Nick, to your point, I'm thinking of one of our builder clients, California, attached urban infill, high density. Well, that's got lawsuit written all over it. They've had virtually no construction defect lawsuits filed against them in 20 years of operation. We helped them set up a risk management program when the company was formed. They have really stuck to the program, and long-term customer service is a big part of it. They also offer things like training for the civilian homeowner board of directors members, and they stay close to the HOA boards, not as a member. They don't want control. They just want influence. And they'll attend board meetings sometimes for 5 or 6 years after completion. Big investment of management time, but man, has it paid off. Other questions? Matt, Mike, any concluding thoughts?
I think, again, a lot of this is from 3 different perspectives, if you will: owner, contractor, and then the sub or the trade contractor. It all applies in one way or shape or form, depending on which side of the fence you sit on. But at the end of the day, you know, it's like having your own car. If you maintain it and you do the right things, it's going to probably last you a lot longer and avoid problems down the road. So I think these guys did a great job. Again, a lot of information, but very informative.
I think along those lines too, what Mike said, reflect back to what Jeff started the presentation saying about we're moving into a more collaborative environment. And like Mike said, everybody's kind of on a different, coming from a different perspective here, depending on whether you're an owner or developer or sub or supplier or designer. But working together, and I think like some of the new contract documents I'm sure you're familiar with, the consensus docs really tries to bring all the parties together to create the right arrangement. Everybody works together to prevent the problems, and everybody wins, so it's a win-win for everybody. To Mike's point, I can't be more grateful to Jeff and John for coming today. I think you heard from the best of the best, and we're really proud that they were able to come up, and thankful for their time here today. And thank you all for coming. We know it was, with the weather out there, and it took a lot of rearranging of your schedules to get here, but we're really appreciative of you coming.
Thank you very much.